Well, good morning, everyone. It is Saturday morning, March 5th. This is Bruce Fleet, President of Fleet Capital Management, and we're going to do our monthly market recap, take a look at how our trading programs did for the month of February. We've also made some changes and adjustments to the system. I'm going to talk about those and show you what has taken place the first week of March, so you can see how those adjustments panned out. I do need to say, if you are viewing this video and not a client of Fleet Capital Management, please do not take anything that is said during this webinar as a recommendation to buy or sell. If you are interested in getting personal recommendations for your situation and your portfolio, please visit our website, www.fleetcapitalmanagement.com, and you can contact me through that website, or feel free to email me directly at brucefleet@gmail.com. Now we have our legal disclaimer out of the way. Let's take a look at some charts and see what happened for the month of February. It was a difficult month, to say the least. But first, what we're going to do is I want to show you what trends. I talked to you a lot about trends, and I want to show you what trends look like, how we identify them, and then what we've been experiencing really since the beginning of January 2015. But this chart that you can see goes back, and let me pull up my little inspector. This goes back to March of 2012. And what you'll see is the market goes up and down, of course, and this is daily. So every little tick on this chart is one day. But you can clearly see, I mean, it's just obvious to the naked eye that we are in an uptrending market. Yeah, we had a down dip here, but then we just continued that uptrend. The 50, the blue, which is the 50-period moving average, never went down below the red, which is the 200-period moving average. I'll come back to that. But that's one indication of a continuation of a trend, even though you had this down dip in October of 2014. There are lots of ways that we identify a trend, and these moving averages are one of the primary ways. So this is what a trend looks like. Now, if we scroll over just a little bit, actually I'm going to annotate this, so bear with me. I'll turn off the inspector. We're going to run down to our annotation system so I can draw some lines for you. Let's go over to 2015. This line right here marks the beginning of 2015. And what I'd like you to notice is up until August, when we had that big fall, in this period, we really began to have a sideways market. Things were starting to break down. I don't know if you remember, I told you in 2015 that I didn't expect very much in the way of returns. And the way, I don't even remember what caused me to believe that right now. It's been a while, but as you can see, it became more of a sideways market. You see that blue 50-period moving average? It started to flatten out. We're back here, it was clearly rising. It started to flatten out, and this became the beginning of a difficult market. And then this first big down drop was the August collapse of the market. And this is actually right when we started to roll out these new trading systems. Thank God we did it then, because it saved us a fortune. You can see that the 50 period moved down. You can see that it crossed under the 200 period. And I'll go even over to the beginning of 2016, draw another line. And what you can see is the price action here and the price action at the end of this space that we're looking at were about the same. So even though we had this dramatic downturn and then upshift and then coming back down, there was really no money to be made. We saved a lot of money, but it was a difficult market to make money. And then if we continue over, now we're in this period. Here's the beginning of 2016. 2016 started out with a dramatic pullback in the market. It has since been coming back up. We're going to look at that. But what I guess the point is that I want you to notice is, in a trending market, whether it's trending up or trending down for a period of time, and it doesn't have to be years, it can be months, I hate to use the word easy, but it is significantly easier than it is today to make money. We can make a lot of money in up trading markets. We can make a lot of money in down trading markets. When a market goes sideways like this, it's very, very difficult. When a market goes sideways like this and has big collapsing periods of underperformance, yes, we can save money, but it's hard to make money. And I'm just getting your eyes trained to see the chart a little bit more like I see the chart. So that's kind of a long-term look. Now, let me delete these lines. Once again, bear with me. And we're going to go back to the chart, and let's take a look at February. What I have here is the entire month of February. I've done a 30-minute bar chart. What that means is each bar, and these are called candlesticks, represents 30 minutes. You can see February 1st, 2nd, 3rd, and so on through the end of February, the 29th. A couple things I'd like you to notice here. Again, I'm going to turn on my inspector, and I'm going to go to the first day of February, and what you'll notice is the market opened. If you see the O up top, it opened at 1936.94, and this is the S&P 500 I'm looking at. So just keep that in mind, 1936, plant that in your mind. Let's go to where the market closed on February 29th. It closed at 1938. So, excuse me, at 1932. So the bottom line is, for the entirety of the month of February, the market went nowhere. It opened and closed. I mean, we could have just gone to the beach and had a margarita and skipped the entire month, and our open and close would have been exactly the same. Very, very difficult to make money during a market like that. It's a sideways market. But there were some trends in there. We made a little bit of money in the beginning of February, noticing this downtrend. You can see the blue 50 period is below the red 200 period. That is clearly marking a downtrend. And then we gave some of that back up as it just immediately reversed and started to come back. And then the market just bounced all over the place and ended where it started. We didn't have a great February. Towards the middle of February into the last week or 10 days of February, I began to be concerned as to why the trading platform that I have built wasn't giving me better signals that would have helped us take advantage of some of this movement a little bit more. And I got in touch with the people that I work with over in India, Rahul Mohindar. You've heard me mention his name many times. Their analysis is part of the program that I've built. That I'm going to show you their analysis. I'm going to show you the changes that we've made, the adjustments. Before we leave this page, one other thing I want you to notice. When a candle is small, see these small candles? That means there's not a lot of volatility. When candles are large, there is significant, dramatic volatility, and we had a lot of those candles throughout the month. We had tremendous swings. If I go to a daily, let's see how this will look for us, if this makes sense. We just had these, now each candle is one day. We had these big swings. We were big down, big down, big down, then big up, big up, wild swings in the market. That's very abnormal. You don't want to see that type of major volatility in the market, but that was what we had to deal with. Now, let me go over to, bear with me a second, I'm going to show you the indicators that I was using, and I'm going to show you some of the changes that we've made. So this is another computer that we're looking at. I'm just tapping into it remotely. And these are the charts that I use on a minute-by-minute basis every business day. These are primarily from Rahul Mohindar. So let me show you some of the changes we made. This is a trend model, and I'll explain to you. It looks a little bit confusing, but it really isn't. The black lines that you see here, those are each represent one day. The tick pointing to the left is the opening price. The tick pointing to the right is the closing price, and the bar in between is just the activity that took place that day. So on this particular bar, we opened and then closed very close near the top. So that was a really good day. When I was mentioning volatility to you, look at this day. We opened at this price, dropped dramatically, went up dramatically, and then came back down and closed just a few points higher than we opened. So if you're the type of person that just watches the evening news and when the commentator says the Dow Jones Industrial Average closed up 6 points, you would have seen from this tick to this tick, let's say with 6 points, but you wouldn't have seen the dramatic volatility that throws us out of positions. We get stopped out of position. So this was kind of the volatility I was talking about. But anyway, back to this. Each black line represents 1 day. The green line, which I hope you can see, it's kind of a lime green line, updates once per day, and this is the trend predicting indicator for very, very short term. This is for 1 day, and the way you read this is if a bar closes above the green line but below the red line, it's suggesting that there may be a move up over the next 1 or 2 or 3 days. Okay, so the green is a daily indicator. The red is a weekly indicator. And what that's suggesting, and it updates, you can see how it looks like it stair steps. It only updates once a week. And it's looking out 1 to 2 to 3 weeks, but certainly less than a month. And the way you read this is if a bar closes above the green, which is the daily, and the green is above the red, which is a weekly, it's suggesting we may have a stronger move over the next week. And I hope that makes sense. So in this one chart I'm looking at, and this was created by Rahul, and I've adjusted it. I'm not even plotting the monthly indicators because I think those are less relevant for the type of trading we do. So I take his information and I adjust it to fit our trading styles. But you can see that the green line fell below the red line and the market itself was below both of them. That's a pretty strong indication that we're going lower. And in a sideways, let me get another little tool over here. If we were to have gone into the market here and then we were in the market until, I don't know, about here, you can see that there were a lot of signals, but I'm going to call those false signals because the market really didn't go anywhere. It's very difficult, and this, I know I'm repeating myself, but this is a very difficult market we're in right now. There's a lot of these periods where nothing seems to be happening. So let me go through, except for a sideways market and whipsaws. So it does make it rather difficult. So we made the change in late to this model. Rahul and I made the change to this model in late February. And in a few minutes, I'm going to show you how we caught a fair amount of this uptrend and how I feel that now that we've made these adjustments to the model, we will be able to be much more profitable, even in this crazy, volatile, sideways, up and down market. And that's what we want to do. We want to be able to make money in any market, but what we ultimately want, obviously, is we want the market to start to find a trend, a longer term trend. So let me close this just for a second. And I'm going to open up one other thing for you. So the performance for the trading account in February was not great. We were down 0.73%. That is net of all fees, costs, transaction costs, everything else. I think that's a real number. The stock market was up just slightly in February. So we underperformed the S&P in February. That's the first month that we've done that. But if you look at our performance line, the green line is our performance. Yes, we went down just a little bit, and it's hard to see here, but it's still equal to or better than, it's actually slightly better than the S&P and the Dow. So we're holding our own, even though I hate to see minimal losses. It was a tough month. And in the medium trend account, what you will see is a little bit different, 0.55 negative on the month, but we're still, and it's a little bit easier to see here, just a little bit easier to see here, that the green line is still equal to or outperforming the S&P and the Dow. And In a bad month, if we're still doing well, that's what we want to see. But going forward, let me go back to this view. What we're trying to do is, like I said, make some adjustments so we can better see the very short-term trends. We're really good at seeing the long-term trends. So before I go to another chart, I want to refresh one thing. If a bar is above the green line but below the red line, we think that over the next 1 to 2 days, and certainly this isn't 100% accurate. This is, no technical analysis is. I think I've said before, it's not a crystal ball, it's a windsock. Shows you kind of the direction. So if the market is above the green line, we think that it has some strength over 1 or 2 days. If the green is over the red and the price is over the green, we think it could be strong for 5 days to 14 days. But then we want to confirm it with one other tool. And this is a volume-based tool, very easy to read. Each tick is the market. The red line is looking at on-balance volume. And when the bars are below the red line, the volume is not supporting the trend. It is supporting the trend if we're in a downtrend. When the bars are above the red line, we are getting support from volume in an uptrend. And you can see just in March, it just turned to where not only, let me go back for you, not only were the bars above the green and the red, but in addition to that, we were getting support for that short-term trend from volume because our price bars were above this is called a strength weakness line, or automated trend model strength weakness indicator is what that stands for. So with that said, now let's take a look at how we've been doing since we made that adjustment. And let me go over here and I use Yahoo just to track my daily performance. And what you'll see is SSO is a symbol that I bought only for the trading accounts. TA is trading, TA and MT is trading and medium trend. This particular security that I purchased on February 25th. It is a 2 times, and with that, it's S&P 500. And what this security means, it's leveraged, is that if the S&P goes up 1%, this security will go up 2%. If the S&P goes down 1%, this security will go down 2%. It has 2 times leverage, so it has twice the risk of a single time. And this security that I bought for the trading accounts February 25th, currently, and this is as of last night's close, Friday night's close, we have a gain of 5.15%, and that's good. In addition to that, we also have in place a 2% trailing stop. So as the price of security continues to rise, our stop, which is an automated sell, continues to rise. But if this were to go down 2% from its high point, then I don't think, and 5.15 is not its high point. We were up as high as about 6%. If it goes down 2% from whatever high we meet, it will automatically sell itself out of the market. And the reason I got this tight stop, you may say, well, why don't you give it more room? Because we're not in an up market. We're not in a bull market. We're actually in a bear market. We're just trying to make money on short-term up moves, but I can't place your money at unacceptable risk levels. So that's why I've chosen this stop level. So this was the first trade I made since making adjustments to our system. The second trade I made was on March 2nd. SPY is the S&P 500, but this is a 1-for-1 or a one time. And what that means is, like the name sounds, if the market's up 1%, we're up 1%. If the market's down 1%, we are down 1%. And on that day, on March, let's see, today is the 5th. On the 4th, the S&P, which is yesterday, Friday, the S&P was up 0.33%. Our investment was up 0.33%. So you can see it's 1-for-1. On that same day, this is just looking at single day, the S&P was up 0.33. The 2 times leverage was up 0.60, just about 2 times the rate of return. So for these investments, since we made that adjustment, like I said, the two times leverage is up 5.15%. The single time for the medium trend and the trading accounts is up 1.09. I'm using a 2% stop on both of them, but, and here's the but, I may pull this stop out and really only sell this if, let me go back here, our price falls below the green and red line. And this red line will adjust Monday. It adjusts every week. And it'll probably be up in this area. It would be my best guess of how that will calculate. So the point is, and I hope I'm not drilling down too far deep in minutia for you for what you're interested in, is that we have made some adjustments. The adjustments are already working. They started working almost immediately, and that's a very, very good sign. I want to show you one other thing that I use, especially for a little bit longer term. And this, I'm not going to take time to explain every line because it would make you crazy, but this is a number of different momentum indicators. What's a momentum indicator? It is judging how much strength is behind the current move. And I've plotted on here about, let's see, 2, 4, 6 different indicators, and then here's the S&P 500. And I'll give you an idea of how this works. Relative strength, I've got a blue line that I personally plotted here at the 50 level. And what this says to me is that when the bars are, or when this indicator is above the 50% level, it's showing pretty consistent relative strength in the market, in the current trend that I'm invested in. Here's a momentum indicator, and I want to show you that it was above. This one uses a 100% line. The momentum was strong, but it's starting to weaken. When we go to the ultimate oscillator, which is a combination of 3 different time frames, it's just starting to weaken. That doesn't mean anything other than I need to take notice that it's starting to weaken, and I may need to tighten my stops. But as you will see, it has weakened before. There are no straight lines, but it does give me pause when momentum is starting to weaken. So if I haven't already lost you in brain dead minutia, I just wanted to start showing you what trends look like and how we are not in a trend right now. When we go back to February, we're just not in a trend. It's just bouncing all over the place. But as I've always said, we will modify and make adjustments as necessary. We made the adjustments, they worked, and we're starting to make some money there. Going back just for a minute, let's adjust this. We've got a daily chart. Bear with me here for a second here. I'm going to go to fill the chart. Okay, so now every bar is 1 day. And let's go to our, since January started, remember that blue line, which is the 50-period moving average? This is the beginning of 2016. The 50-period moving average crossed below the 200-day moving average or period moving average, and that indicates a bear market. So the long-term trend, remember there is short, intermediate, and long-term trends. Long-term trend is the most heavily weighted. We're still in a bear market, even though the market has had a very nice run in late February into March. We're still in a bear market. So we're trying to make some profits off of this short-term run, but we're in a bear market until at which time this blue line crosses back above the red line. The 50 crosses above the 200 period. Until that happens, we're in a bear market. And I will tell you this, I am on the phone or webinars or reading reports from technical analysis around the world. That probably occupies 2 hours of every day. And I will tell you that 99% of them believe that this rally that we've been experiencing is not going to hold, and we're going to head back down, and that we could head down in a pretty aggressive and steep fashion. That's scary. because of that, and these are people who've been doing this for a very, very long time. They are top in their field of technical analysis. It doesn't mean they're right, but what it means is I've got to listen and adjust my trades based on the view of these technical analysts. So I listen to their analysis, and then I incorporate my analysis. And I've got to be honest with you, one of the top technical analysis that I work with in Los Angeles, she has been saying during this entire uprun that this market is about to plummet. Fine, but we got in on the 25th, and we're going to ride this up. So I listen to these folks, but I don't always agree with them. We're going to ride this up, but we're going to protect ourselves if it turns, which we'll have to see what Monday holds, and I'll explain why in a moment. If it turns south, we want to be out, and then we want to start looking for short positions to make money as the market's going down. The reason I hesitated around Monday is, remember, each of these candles is one day, and the pattern of the candle gives us lots of clues as to what the next day may hold. For instance, you see this candle here with this really long tail? This means that the market opened here and it closed here at the top, okay? But during the day, the bears dragged the price way down but weren't able to hold it. The bulls won on that day. We call these psychological candles because in many instances we can see the psychological feel of the traders on the floor of the New York Stock Exchange. When the bears drag it down, but it closes up here, that's a very bullish candle, and you can see the bull market continue to run. Conversely, if you look over here, market opened at the top, closed at the bottom. That's about as bearish it can get. The next day it opened and it closed at the bottom, as bearish as you can get. So when you learn to read these candles, and by the way, these are called Japanese candlesticks. These were invented by the Japanese rice traders, who the ones who figured out that they could see that trading a commodity or a stock was not just mathematics, but it was psychology. They invented this system about 300 years ago. They became, from what I understand, phenomenally wealthy. It's legendary what these guys did in trading rice and different grains. Now let's go back to Friday. You see this candle on Friday? You've got a tail, or a wick, we call it, to the top, which means the stock price on that day ran all the way up as high as here, and then the bears pulled it back down. But also the price went all the way down to here, and then the bulls pulled it back up. This is called a spinning top. You can even see it almost looks like something you could spin on a table, spinning top. What that means is it was a day of indecision. It means that the bulls and the bears were fighting head to head, trying to win the day. No one did. Many times when you get a candle of indecision, the current trend reverses. It doesn't happen every time, but watch this. You see this really long up rally that we had in October? You see that white candle up there? It's a spinning top. It looks very similar to that spinning top, and look what happened. It was a change in direction. So these candles give us clues. The technical indicators give us clues. We have about 100 indicators that I use, that I've created. Here's an indicator. There are more down here. All of these things just help us look for direction and look for trends. With that said, I want to close this month's review with a quick recap. February was difficult. We lost just a little bit of money, but over time we're still beating the S&P and the Dow, which is our ultimate goal, is to beat the S&P and the Dow. We did make adjustments to the indicators and to the analysis that I've created in the trend following system. We employed that analysis, that new analysis, starting February 25th, and so far it's been working very, very well. I'm hoping and looking forward to a very positive March with these new indicators. I'm also, as you are, hoping and looking forward to a breakout of a trend. Does it go up and start a continuation of the long-term bull market that we had for a number of years, from 2009 through 2014? That would be nice. Does it fall apart? And because there are a lot of risks in the market and we have a downtrending bear market for a number of months or the balance of 2016, bear markets don't last as long as bull markets. So I wouldn't be surprised if it lasted 3 or 4 or 5 months or even until the presidential election. We can make money, like I said, pretty darn easily in either a bull or a bear market. It is very difficult to make money in a sideways market. We're doing the best we can. I think with these tweaks that we've made, we're going to really be able to handle this sideways market better and make some more money for you. So that's the monthly review. I know this one was a little bit technical, but I know some of you enjoy this type of analysis and others, your eyes glaze over. I apologize to those of you. I won't do this every time. But I do want you to see what I see, and the future still looks very bright for us. Actually, it's looking brighter and brighter as we adjust these indicators. So with that said, as always, if you have any questions at all, feel free to call me, or it's sometimes easier just to shoot me an email at brucefleet@gmail.com. You know that I always answer all questions. If I do receive a question that I think is relevant to everyone, I'll send that out on a mass email. But always feel free to call me. I'm always here, sitting here from 5:30 in the morning Pacific time until late in the day, every trading day. So I'm always here, and I respond as quickly as I possibly can. With that said, I hope this was worth your time. Have a great rest of your day, and we'll talk soon. Thanks. Bye-bye.